Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Tuesday. It's May 24th. It's 7:38 in the morning. The market's going to open in about an hour and 52 minutes, give or take. Now, as you can see here, we've got new housing starts today. Tomorrow, we've got durable good orders, and Thursday's the big day. It's the GDP. You can expect some subdued trading action going into the GDP, and all attention is going to be on the bond market. And notice, again, I wanted to show you this. I keep showing this every day, but this is really, really important because the long bond has been going down. And since the long bond's been going down, the stock market's been going down with it. But the long bond, remember, the stock market gets its clues from the bond market. And the bond market has been now choppy over 2 months. This is the first time since this downslope has happened. That's telling us that the Fed may be curtailing, or the market expects the Fed inflationary pressure to subside because bonds look like they're ready to go higher. And if that's the case, that's going to slow down interest rate hikes. And if that slows down interest rate hikes, especially on the long bond, that'll give some upside potential for the stock market. So that's very, very, very bullish sign. And the fact that the stock market kept going down and made a new low this month, as you will see right here, this is very, very, very significant. Very significant. Because look, we've been going down. We made a new low, but the bond market, it's been going sideways. And if it turns higher, that means long-term rates are actually expected to go lower, which means there's a good chance, fingers, toes crossed, every extremity crossed, that interest rates may not be going higher anymore. Now, GDP is going to be the big report. I covered that yesterday. We've got FOMC minutes on Wednesday. Today's Tuesday. We've got new home sales. Now, typically new home sales, the numbers have been very, very solid. But last week, we've had existing home sales, and the numbers came out really on the low end. So the point is, we may have another issue with new home sales. This could be a culprit today, so keep your eye on that report. But it is coming out during market hours. Typically, reports that come out during market hours have less of an impact. And also, in light of the fact that we have durable goods, GDP, and FOMC minutes, and the bond market's been fairly stable, I'm not expecting a lot of volatility. Also, with the bond market, volatility has been lowered. We can expect lower volatility in stocks, which is one of the reasons why the VIX index, even last week, we went lower on the S&P and on the Dow and on the QQQ, but the volatility couldn't muster it, and we now look like we're going back down. We have puts actually on the volatility, so if volatility cools off some more, we'll be in the money. We'll be profitable probably around the 26, 25 level, but obviously we want to make more money. So, or be positive. We were positive like 5-10% at one point, and then we went back up, and now we're cooling back off. But the option doesn't expire for several months. The bottom line is I have a put in volatility right now. Now, let's talk a little bit about global economy. So, global shares declined Tuesday as worries over inflation tempered. And this is smart. President Biden's remark was consider reducing U.S. tariffs on Chinese imports. That would give us some advantage right now. Biden, who announced new economic and trade initiatives with the region while on a visit to Japan, confirmed reports that he planned to discuss the issue of punitive tariffs imposed on China during the President Donald Trump administration. If that happens, keep your eye on small caps. Small caps have the biggest sensitivity to China, and that's one of the reasons they've been moving higher. Let's see what else. Let's see what else is going on here. Investors fear U.S. central banks could go too far in raising rates or move too quickly. That could slow down business activity too much. It's a walk on a razor's edge right now. On Wednesday, investors will get more detailed glimpse into the Fed's decision-making process with the release of minutes from the latest policy-setting minutes. Now, Wall Street will get a few economic updates this week from the Commerce Department. On Thursday, it will release its GDP report. Very, very big. And on Friday, personal income. Other news, we have now I keep saying Bed Bath & Beyond. We have Best Buy reporting today. Now, I think the number is already out. And when I typed it in, I think the number looks really solid because the stock is up 4%. So I don't have the exact confirmation, but this is very positive. And remember, Best Buy is a tech consumer discretionary company. So if we're starting to see good side from Best Buy, that's very, very positive. And remember, I want to say this to you guys here too. One of the reasons why consumer stocks went down hard last week was because of Target and Walmart. But Target and Walmart, the biggest problems they had was not people spending money. Their revenue was higher. Look at the revenue was higher. They couldn't meet their numbers because they didn't have any good supplies in stock. People weren't interested in summer beach chairs. So keep that in mind. So if we see demand, further demand, consumer demand, like from Best Buys or other stores like Big Lots that's reporting, or Dollar General that's reporting on Thursday, that could be really, really significant. So keep your eye on this number. But more importantly than the number, look at their forward-looking statements. The forward-looking statements is the key. But they're expecting $1.63 and $10.4 billion in revenue. And we'll get into the other ones later on, but that's the number to expect today. Now, in terms of, let's see, stocks and the sectors, I want to show you in a little bit of a sector analysis. So far, we haven't had much of a move on a cumulative basis. Energy, utilities. Now, consumer staples has gone down and healthcare has gone up. Healthcare is a fairly neutral sector. So the fact that healthcare is going above materials and consumer staples doesn't really mean much, because basic materials is fairly defensive. Consumer staples is fairly defensive. Industrial is fairly defensive. And healthcare, it can go either way. And all of this is speculative. So you really do have a pretty good picture of healthy sectors versus unhealthy sectors right here. These are in demand, and I'm expecting consumer staples to actually come up because I think it's a little overdone to the downside. But in terms of sectors, you still have energy leading and you have consumer discretionary lagging. And if we go to our chart here, we will see that you still have all the same names: the Oxy, Devon, the Valerio, US Marathon, Apache. We're long Apache right now. You really can't go wrong any of these. You're not gonna gain a major advantage of picking Halliburton over Valerio, as long as you stick with this group right here. And by the way, just so you know, let's go back 80 days. You'll see the same stocks. Oops, not 7,080 days. Let's go back 80 days. Notice Devon, Apache, US Marathon, ConocoPhillips, same stocks. Pioneer, McKesson. January 27th, let's go back to today. You see why I use this? It works. So again, the energy stocks are the best sector. And honestly, I like Apache right now. And I like Pioneer Natural Gas because I believe there's a lot more upside right now in natural gas, because it's part of the basic material manufacturing process than energy stocks alone. So we have to consider that right now. So I like Pioneer, I like Apache, I like these stocks right now. Now, as far as on the bottom side, Etsy, Netflix, Dish. Again, Netflix is really, really nasty right now. Bed Bath & Beyond is really nasty right now. I would stay away from PayPal because it's a communication stock. Target is really nasty right now. Amazon is pretty nasty right now. And look at Best Buy. It's down here, but it may be turning the page. But again, I would stick with the retail stocks like Gap, like Netflix, like Etsy, PayPal communication, Target, Amazon. I would avoid Best Buy for right now, but those are the stocks you'd want to focus on in terms of the weakness. Now, before I let you go, I want to show you guys something interesting. The Dow Jones was up 2% yesterday. The Russell 2000 was up only 1.21% yesterday. The QQQ yesterday was up 1.66. They're starting to show some more stability, especially the small caps, and especially if Biden has a talk with Xi. But my point is, it looks to me like we're going to move from a down market to a choppy market, which could potentially reverse. We don't need a lot of upside for the market to turn bullish, but I believe we are way, way overdone because this divergence is crazy. This last low we made, RSI couldn't even go below 35. So I think it'll take us at least to, I think we need to see us go to 319, 318, to this level right here, to the bottom of the previous low. I think if we can pass that level, we have a good chance of moving to the 50-day moving average. That level right now is 318. On the Dow Jones, let me give you that level on the Dow Jones. On the Dow, that level is right around 32,500. We're like around 31,600, so about 1,000 points higher. We need to go about 1,000 points higher to get out of this crazy twilight zone, as I like to call it, this period right here. So it's not a good position. So I do believe we're going to come out, and I think this may be a little outlier, the words we've been using lately. But anyway, keep your eye on the Russell 2000. The Russell 2000, if China and U.S. start communicating and start getting better, this will have a much less impact on these stocks. Notice the Russell 2000 did not break the low, right? You see that? It didn't break the recent low, but look at QQQ. You broke the low. Let's see if the Dow broke the low. We broke the low. Let's see if we SPY, we broke the low. We broke the low, but look at the Russell. The Russell did not. And either did XLC, the communication sector. That's very, very, very bullish. It did not break the low. See, didn't break the low. QQQ broke the low. Remember, the Russell and XLC were the two assets that started triggering this whole thing after the bond market. So the fact that the bond market is moving choppy, the fact that small caps and the communication sector is no longer moving lower, and earnings are actually better than expected, could be very, very positive. But again, all eyes on durable good orders today. Just to give you an idea of the expectations, tomorrow, not today, tomorrow, durable good orders and GDP. So they're looking at a consensus, a positive consensus of 0.5. But look at the range, all the way from negative 0.001 to positive 2. That's a big range. So again, there's still a lot of uncertainty, less uncertainty than we had a month ago, which is why I think the market is now looking forward once again. But this GDP is going to be very, very instrumental in what the Fed does and how it reacts. Keep your eye on the bond market. If we keep getting sideways action or upside, that means the long bond doesn't want to go lower, and that means interest rates are not interested in going higher. That's very, very bullish for the stock market. Now, before I let you go, I've got something really important for you. The stock market's recent sell-off has left many traders scrambling. Not me. I'm playing the lows to my advantage. That's because I created a system with the initial purpose of being built for a bull market, but it ended up working even better in a crashing one. And it's led to some interesting trade opportunities, very interesting trade opportunities that you need to see in order to believe. At 1 p.m. Eastern Time on Tuesday, May 24th, I'm hosting an educational training session to show everyone how it works. Click on the link below to reserve your seat now. And tomorrow, I'm going to give you some red meat, long trade, short trade, actionable trade ideas. You don't want to miss out. Follow the link below. If you can't find this link, go to the YouTube descriptor. It's in the YouTube channel. Find it there. And I'll talk to you guys tomorrow. Follow the link. I hope to see you at 1 p.m. Eastern Time in today's class. I'll see you guys later. Have a great day. Bye, guys. Comments, love letters, feedback. I want to hear from you guys. Send me an email, support@marketgeeks.com. I haven't heard from you in a while. Am I helping you at least a little bit navigate these markets? Let me know. Bye, guys. Have a great day.